The ground beneath the global financial system is shifting, and what happens next could reshape your economic future. A senior figure at Vanguard, one of the world's most powerful investment firms managing assets worth $10 trillion, has just sent out an alarm that's reverberating through Wall Street and beyond. His message is blunt and unsettling. American equities have become dangerously expensive, and investors who stay the course may be in for a rude awakening. This isn't the usual market chatter or routine analyst skepticism. This is a fundamental reassessment of where the United States economy stands in the global order. The numbers tell a sobering story. The price-to-earnings ratio of the S&P 500 has climbed into territory that defies historical norms. Meanwhile, company profits have essentially stalled, growing at a pace that barely outpaces the rising cost of living. Vanguard's forecasts paint a picture of American market returns that look anemic, particularly when placed alongside the much brighter prospects emerging in other parts of the world. But the warning doesn't end with overvalued stocks. There's a parallel crisis unfolding with the US dollar itself. For the first time in modern history, the greenback's dominance in global reserves has fallen below 50%. Landing at just 47% in early 2025. To put that in perspective, at the turn of the millennium, that figure stood at 71%. As recently as a few years ago, it was 57%. This isn't a gradual decline anymore. It's accelerating. Leading this financial exodus is China, systematically reducing its holdings of American government debt while stockpiling gold at an unprecedented rate. Central banks across continents are following suit, quietly diversifying away from dollar-denominated assets. The BRICS coalition, consisting of Brazil, Russia, India, China, and South Africa, along with several new members, is aggressively working to build alternative financial infrastructure that could eventually sideline the dollar in international commerce. The implications are profound and personal. As global appetite for the dollar weakens, the cost of borrowing for the United States government is expected to rise. With national debt already exceeding $37 trillion, higher interest payments mean tough choices ahead, potentially higher taxes, reduced government services, or both. For ordinary Americans, a weakening dollar translates directly into higher prices for gasoline, groceries, electronics, and nearly everything else that crosses our borders. Meanwhile, American stock markets have begun to wobble while European exchanges are posting solid gains. Layer on top of this the tariff policies implemented during the Trump administration, many of which remain in effect, and you have the ingredients for significant economic turbulence ahead. This isn't fear-mongering, it's pattern recognition based on hard data and historical precedent. So what should you make of all this? And more importantly, what can you do to safeguard your financial well-being as these tectonic shifts unfold? Stay with us as we unpack the forces reshaping the global economy and explore practical steps you can take right now. Make sure to subscribe, because understanding these dynamics could be the difference between weathering the storm and getting swept away by it. When the giants speak, markets listen. Greg Davis holds one of the most consequential positions in global finance. As Vanguard's chief investment officer, his assessments carry weight because they're backed by one of the largest pools of investor capital on the planet. And his recent statement about U.S. equities wasn't wrapped in the usual diplomatic language that typically characterizes institutional commentary. He was direct: American stocks are overpriced, and disappointment lies ahead. Consider what American investors have enjoyed over the past 10 years. The S&P 500, which serves as a barometer for the largest publicly traded companies in America, has delivered average annual returns of 12.4%. That's exceptional by any historical standard. But according to Vanguard's detailed modeling, that extraordinary performance is about to give way to something far more modest. Their projections suggest annual returns between 3.8% and 5.8% over the coming decade, clustering around 5%. That represents a dramatic cooling from recent experience. What's behind this pessimistic forecast? The fundamentals simply don't support current prices. The S&P 500's price-to-earnings ratio, which measures how much investors are willing to pay for each dollar of corporate profit, currently sits near 30. Think about that for a moment. You're effectively paying $30 for the right to claim $1 in annual earnings. That's expensive by historical standards. Vanguard's analysts also reference the cyclically adjusted price-to-earnings ratio, commonly known as CAPE, developed by Nobel laureate Robert Shiller. This metric smooths out short-term earnings volatility to give a clearer long-term picture. By this measure, U.S. stocks are trading roughly 49% above what would be considered fair value. Imagine walking into a store and knowingly paying $149 for an item worth $100. That's essentially what's happening in the stock market right now. The profit picture makes things even more concerning. Between the end of 2021 and early 2025, earnings per share for S&P 500 companies crept from $198 to just $217. That's less than 10% growth over more than 3 years, barely enough to match inflation. Without robust profit expansion to justify today's lofty stock prices, the market starts to look precarious. Here's where it gets personal. If you've been investing consistently but haven't actively rebalanced your portfolio, you might be sitting on far more risk than you realize. The traditional balanced portfolio, a 60-40 split between stocks and bonds, has been dramatically skewed by a decade of outperformance in equities. Stocks returned over 12% annually, while bonds limped along at around 2%. Without regular rebalancing, that 60-40 allocation may have morphed into something closer to 80-20, leaving you heavily exposed just as valuations reach extreme levels. The geographic concentration is equally concerning. U.S. stocks have outpaced international markets by roughly 6 percentage points per year over the past decade. If you started with a 70-30 mix between domestic and international equities, market drift alone could have pushed you toward 80-20 or even more lopsided. That means the bulk of your wealth is now tied to the most expensive segment of the global market. This isn't just theoretical risk. The S&P 500 has experienced significant volatility recently, while European markets have climbed approximately 9% and appear to have positive momentum. This isn't a temporary blip or normal market noise. It signals underlying stress in the system. Between stretched valuations, stagnant earnings growth, and nervous investors, the American market is exhibiting signs of instability. If the majority of your investments are concentrated in U.S. equities right now, Davis and his team believe you're exposed to considerable downside risk. And when Vanguard speaks, it's worth paying attention. They don't just manage $10 trillion, they oversee more than a quarter of all mutual fund and exchange-traded fund assets in the United States, second only to BlackRock in total size. Roughly 80% of their index funds have beaten competitors over the past decade, largely due to their famously low fee structure. Vanguard's founder, John Bogle, transformed the investment landscape back in 1975 when he launched the first index fund available to retail investors. Before that innovation, broad, low-cost market exposure was essentially unavailable to ordinary people. Now, nearly 50 years later, the firm bearing his legacy is sending a clear signal. The U.S. stock market has overheated, and it's time for investors to recalibrate. Shifting some allocation toward international equities and bonds may no longer be optional. It may be essential for risk management. The party has been wonderful while it lasted, but according to Davis, the consequences of excess are already beginning to materialize. While American stocks show signs of fragility, an even more fundamental shift is underway. The U.S. dollar, long considered the bedrock of global finance, is losing its grip on the world economy. This process, known as de-dollarization, is accelerating at a pace that would have seemed unthinkable just a generation ago. The numbers are stark. In 2025, the dollar's share of global foreign exchange reserves dropped to 47%. That's the lowest level on record. In the year 2000, that figure was 71%. Just a few years back, it stood at 57%. This isn't a gradual erosion anymore. The pace has picked up dramatically. To put it in trade terms, between 1999 and 2019, roughly 96% of all commerce conducted across North and South America was denominated in dollars. That near-total dominance is now visibly crumbling. Why should you care about reserve currency statistics and trade denomination? Because these seemingly abstract financial metrics have concrete effects on your daily life. When global demand for the dollar decreases, its value falls relative to other currencies. That makes everything America imports more expensive. According to analysis from J.P. Morgan, this shift away from the dollar could increase U.S. government borrowing costs by half a percentage point, potentially even a full point. That might sound trivial until you consider the context. America's national debt has surpassed $37 trillion, representing more than 120% of the entire economy. Higher borrowing costs mean the government has to spend more just to service existing debt. That leaves less money for everything else: infrastructure, education, defense, social programs. The pressure to either cut spending or raise taxes intensifies. Either option creates economic and political pain. But government finance is only part of the story. A weaker dollar hits consumers directly through inflation. That gallon of gasoline could easily exceed $5 in many parts of the country. Clothing, electronics, household goods, much of what Americans buy comes from abroad, and all of it gets more expensive when the dollar weakens. This kind of inflation is particularly insidious because it's driven by currency depreciation rather than domestic demand, making it harder for policymakers to control through traditional tools like interest rate adjustments. Since the end of World War II, the U.S. dollar has functioned as the world's primary reserve currency, a role that conferred enormous advantages. It meant the United States could borrow cheaply, run persistent trade deficits without immediate consequences, and exert significant influence over global financial institutions and regulations. But that privileged position rested on one crucial foundation: trust. Trust that America would remain stable, predictable, and committed to the rules-based international order it helped create. That trust is eroding. Countries around the world are beginning to question whether they can rely on the United States as a stable economic partner. Political polarization, inconsistent policy from one administration to the next, and the weaponization of the dollar through sanctions have all contributed to this reassessment. And when trust fades, so does the dollar's dominance. This isn't an abstract concern for policymakers and economists. It's about your purchasing power, the value of your savings, and the cost of your monthly expenses. As the dollar weakens, every American household will feel the impact. Behind the dollar's decline lies a calculated and determined effort by the world's second-largest economy. China isn't just passively watching America's financial dominance fade. Beijing is actively working to accelerate that process, and they have both the resources and the motivation to make it happen. Since 2021, China has reduced its holdings of U.S. Treasury bonds by approximately 25%, dropping from $1 trillion to around $765 billion. At the same time, Chinese authorities have been accumulating gold reserves at a remarkable pace, adding 290 tons during 2024 and into 2025, according to World Gold Council data. What prompted this shift? In large part, it was the 2022 decision by Western nations to freeze roughly $300 billion in Russian central bank assets following the invasion of Ukraine. That move sent shockwaves through Beijing. If the United States and its allies could freeze another major power's reserves overnight, what guarantee did China have that its own dollar holdings were safe? The answer: none. So China began diversifying away from dollar-denominated assets as a form of financial insurance. But China's strategy goes beyond defensive positioning. Through the Belt and Road Initiative, Beijing has signed agreements with approximately 150 countries to conduct trade using local currencies instead of dollars. In 2024, yuan-based trade with the Association of Southeast Asian Nations surged by 20%. These aren't trivial numbers. They represent a systematic effort to create alternative financial pathways that bypass American-controlled systems. Yet the yuan isn't ready to replace the dollar as the world's primary reserve currency. It currently accounts for only about 4% of global foreign exchange reserves, largely because China maintains strict capital controls that limit how freely money can flow in and out of the country. International investors and central banks want liquidity and predictability, qualities the yuan doesn't yet offer. Still, China's objective isn't necessarily to replace the dollar outright, at least not in the near term. The goal is more modest, but still consequential: reduce dependence on the dollar, protect Chinese interests from American policy decisions, and gradually increase Beijing's influence in global financial governance. If this strategy succeeds, the United States will face rising costs to borrow, more persistent inflation, and a diminished ability to use financial leverage in geopolitical disputes. This is a long-term power struggle playing out in bond markets, trade agreements, and currency reserves. And right now, Washington appears to be playing defense. The BRICS alliance builds alternatives. China isn't operating in isolation. It has powerful partners, and together they're constructing an alternative financial architecture designed to function independently of Western-controlled systems. That coalition is BRICS, originally comprising Brazil, Russia, India, China, and South Africa, and now expanding to include additional nations. The group is developing a blockchain-based settlement currency intended to circumvent SWIFT, the dominant international payment messaging system that operates largely under Western oversight. Trade denominated in yuan and rupees has increased by 15% during 2024 and early 2025. Russia and India are already conducting oil transactions settled in rupees, completely excluding the dollar from these exchanges. Of course, the path forward isn't smooth. China carries substantial debt burdens. Brazil's financial markets remain vulnerable to global shocks. And despite considerable discussion, there's still no official unified BRICS currency that all members have committed to using. Internal disagreements and competing national interests create friction. Nevertheless, momentum is building. Even Saudi Arabia, long one of America's closest partners in the Middle East and a cornerstone of the petrodollar system, is reportedly exploring the possibility of accepting payment for oil in currencies other than dollars. That would have been unthinkable just a few years ago. If BRICS succeeds in establishing viable alternatives to dollar-based trade and payment systems, the consequences for the United States would be significant. Reduced demand for dollars would weaken the currency's value, making imports more expensive and inflation harder to control. American consumers would bear the brunt of these changes through higher prices for goods and services. This isn't merely a currency dispute. It represents a fundamental rebalancing of global economic power, and the outcome will directly affect your financial security and quality of life. The unraveling of America's safe haven. For generations, United States Treasury bonds represented the gold standard of safety in global finance. Governments, pension funds, insurance companies, and individual investors around the world parked their money in U.S. debt because it was considered virtually risk-free. That consensus is now fracturing. Yields on 10-year Treasury bonds have climbed to approximately 4.5% in 2025. That might not sound alarming at first, but context matters. In a healthy, stable economy with strong demand for government debt, yields should remain relatively low. Rising yields indicate the opposite. Investors are demanding higher returns to compensate for perceived risk. In other words, they're walking away, and the U.S. government is being forced to offer more attractive terms just to find buyers. According to financial data, investors have pulled more than $60 billion out of U.S. stocks and bonds this year alone. What's driving this exodus? Several factors converge. The national debt has swelled to over 124% of GDP, raising questions about long-term sustainability. Trade disputes initiated during the Trump administration, many of which continue, have created uncertainty about America's economic trajectory and reliability as a partner. Even long-standing holders of U.S. debt are reconsidering their positions. Japan and China collectively own more than $1.7 trillion in Treasury securities. Both nations have reportedly discussed reducing those holdings in response to American economic and trade policies. Such a move would be devastating, potentially triggering a spike in interest rates and forcing painful fiscal adjustments. In a development that would have seemed impossible a decade ago, German government bonds are now perceived by some investors as more stable than their American counterparts. Europe is beginning to replace the United States as the destination of choice for capital-seeking safety. If America can't easily sell its debt, the government faces stark choices: raise interest rates to attract buyers, which slows the economy and increases the cost of servicing debt, or cut spending dramatically, which means fewer jobs, reduced services, and political upheaval. Neither path is pleasant, and both carry significant costs for ordinary citizens. An economy walking a tightrope. While trust in American debt instruments deteriorates, the broader economy is showing signs of strain. The United States is trying to navigate a narrow path between inflation and recession, and that path is getting harder to walk. Inflation ticked up to 2.7% in June 2025, compared to 2.4% a year earlier. That might seem like a modest increase, but it masks deeper problems. Tariffs imposed during the previous administration, most of which remain in place, are quietly pushing up the cost of everyday items. Prices for clothing, electronics, and certain food products have surged nearly 20% in some categories. Consumers are feeling the squeeze. J.P. Morgan analysts now estimate the probability of a recession at 60%. That's not a fringe view. It's coming from one of the most sophisticated analytical teams in finance. Corporate spending has already contracted by 4% in just the opening months of 2025. Consumer confidence has fallen to its lowest level in 2 years. People are buying less. Companies are slowing hiring. Retail sales are shrinking. The Federal Reserve finds itself in an impossible position. If it maintains high interest rates to combat inflation, it risks pushing the economy into recession. If it lowers rates to stimulate growth, it could reignite inflationary pressures. There's no clear path that avoids pain. For workers, the situation is particularly frustrating. Wages aren't keeping pace with rising costs. Job security feels tenuous. Businesses are bracing for impact rather than expanding. The sense of economic anxiety is palpable across income levels and geographic regions, and the world is watching. American trade policy, the continuation of tariff regimes, and unpredictable leadership have generated frustration and anger internationally. This isn't just adversaries pushing back. Long-standing allies are quietly distancing themselves from American economic and political positions. What this means for you. So where does this leave you, the individual trying to build a secure financial future? The message from Vanguard, from market data, and from global economic trends is clear. Diversification is no longer optional, it's essential. If your portfolio is heavily weighted toward U.S. stocks, particularly if you haven't rebalanced in years, you're carrying more risk than you probably realize. Consider shifting some allocation toward international equities, which are currently cheaper and may offer better returns over the coming decade. Bonds, despite their recent struggles, still play a role in moderating portfolio volatility. A weakening dollar means inflation will be harder to escape. Consider investments that tend to hold value during inflationary periods, such as real estate, commodities, or Treasury inflation-protected securities. Holding some portion of wealth in assets not denominated in dollars, whether foreign currency, international stocks, or gold, provides a hedge against further dollar decline. Stay informed, but don't panic. Markets move in cycles, and periods of turbulence eventually give way to stability. The key is positioning yourself to weather the storm without making emotional decisions that lock in losses. Review your portfolio with a critical eye. Understand your exposure. Make adjustments thoughtfully. The financial landscape is shifting beneath our feet. The era of unchallenged American economic dominance is fading, replaced by a more multipolar world where power is more distributed and outcomes less certain. That transition will be bumpy, and those who recognize it early will fare better than those who cling to outdated assumptions. This story is far from over. The decisions made by policymakers, investors, and ordinary people over the coming months and years will shape the economic reality we all inhabit. Stay engaged, stay informed, and most importantly, stay prepared. The ground is moving, but that doesn't mean you have to fall.